Welcome to Top of Mind, the show where we talk to real estate industry insiders and experts about the biggest trends impacting the market today. Enjoy the show.
Mike Simonson here. Thanks for joining me today. Welcome to the Top of Mind podcast. This is where I talk to the smartest leaders, thinkers, and doers in the real estate industry. For a couple of years now, we've been sharing the latest market data every week in our weekly Altos Research market report video series. With the new Top of Mind podcast, we're looking to add some context into the discussion about what's happening in the market from the leaders in the industry. Each week, Altos Research tracks every home in the country, all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional data channels. Visit altosresearch.com for a free consultation on how you can use the market data in your business today. Okay, without further ado, let me introduce my guest today. Dan Green is the founder and CEO of homebuyer.com, the mortgage lender for first-time homebuyers. Prior to homebuyer.com, Dan founded the popular consumer website, The Mortgage Reports, which was later acquired by a leading mortgage company. While he was publishing the mortgage reports, Dan also worked as a retail loan officer and was a perennial top producer, setting production records in multiple years. Through his websites and his businesses, Dan has helped fund more than $12 billion in mortgage loans. Full disclosure, I am such a fan of Dan's that I am also an investor in Homebuyer. So Dan, welcome. Thanks for joining me. This is a very timely topic because I am definitely not an expert on mortgages. So you're going to be my masterclass today.
Oh, that's awesome.
So welcome to the Top of Mind podcast. So as we get started, why don't you tell me about homebuyer.com? Tell us about where homebuyer.com came from, why it's amazing, and a little bit about you.
Sure. Before we get started, I was telling you, I haven't gone 5 days without shaving since I was about 18 or 19 years old. And nobody told me there'd be a video portion of this podcast.
You're a star now.
I'm glad this is on for posterity. For everybody listening on radio, hop over to the YouTube channel and check out this 5 days here. The microphone pick it up,
and the Homebuyer T-shirt.
Yeah, do have the T-shirt on, but that's attire every day. I'm always wearing the T-shirt, and so my kids will always know when it's not a working day because I'm wearing some other startup's T-shirt.
If you get nothing else out of this startup adventure, you've got a new wardrobe.
I have so many T-shirts. I take the Superman approach. There's actually just a stack of T-shirts in the closet, and I just take the top one every day. Same outfit every day. No, it's good to be here. For background on the company, and thanks for the intro. I've been in mortgage lending since 2003. Right before this, I was a software engineer, and that's kind of relevant in the context of what I do now. And so one of the very interesting things that happened came through .com, and the .com. A lot of software engineers, there's a lot of shakeup. And so in the aftermath, I was doing some consulting work, and I ended up doing some consulting work for a mortgage company. And one of the things that was super interesting to me about mortgage, different from helping a corporation, right? If you're writing software or you're building process at a corporation, you're saving an entity money or you're helping drive value for shareholders. And that was great. But the thing that was excellent about working for this mortgage company, doing project, I built a CRM for them. What was really interesting was that it was actually working with people, right, and making a meaningful impact to homebuyers, and specifically people who are trying to get into home ownership, didn't know how, didn't know what to do, were stuck. And so on my first, I finished the project. It's funny. I said to the company owner, I said, "Hey, when this project wraps up, I'd love an opportunity to come work here." And he's like, "Well, we only do contract work for software." I'm like, "No, I'd like to be a loan officer." And on my first day of training, We sat in this room, and the trainer was one of the company owners, and there's 7 or 8 of us sitting in the room, and he says, your customer is the real estate agent. It was almost the very first thing that they said. Not that your customer is the actual home buyer, but your customer is the real estate agent. And what they were saying was that if you're going to succeed in this business, you need to make friends with realtors. And they talked for weeks. I mean, it was a long training practice, and they talked for weeks about how to deliver value to real estate agents. Show up with rate sheets, bring them donuts, go hang out, make conversations, go to the open house, do flyers, and all of that was getting farther and farther away from the things that was really interesting to me. And I came from the software background, so as you mentioned, the mortgage reports, I started writing as I was learning about the industry. I started keeping a public log of it, and I became a student of the business. Instead of, going out and walking around a realtor's office at Tuesday in the middle of the day, like what realtors are in their office at 2 in the middle of the day on a Tuesday? They're the ones that aren't selling houses. You realize that pretty quick, right? And so I was taking the things I learned, I was putting them onto a blog. I was using early blogging tools. I was on Blogger, I think, in the beginning, and then I moved over to TypePad, if you remember those tools. But what the value was in actually getting out and communicating information to home buyers.
This is almost 20 years ago.
This was 2003, 2004, 2005. And I got religious about it. And it was as much as it was for, I'd meet with a one member of a household, maybe it was a wife, maybe it was a husband, or maybe it was a fiance and not the other fiance, or maybe, whoever it was, a young home buyer who was conversing with their parents, but there's always a second party involved, but both parties didn't ever come to the meetings. Right. So I was using the content as a way to say, hey, we talked about these topics. Here's a web page where you can go read up on the things that we talked about. Go take this back to, whoever else is helping you make decisions, and let's circle back. And that website, it helped me to produce. I was the rookie of the year. I was able to get really efficient about my time. But what was the really interesting thing was that it wasn't the leads that were coming into me that I found that there was huge value, is that the internet is international. It's not just limited. I was in Chicago at the time. It's not just Chicago. It's not just Illinois. It's the entire United States and beyond. And so what is interesting about having a healthy web presence is that you bring in traffic from everywhere. And I can only handle so much. So over time, we began to go through these, I started writing software to help cull the inbound flow. First it was, 1 lead a month that would come in. They'd fill out a form on the site. And I was like, oh my gosh, 1 lead a month. And then, it'd be 1 in a week, and then it'd be 1 in a day. And then it'd be like, 1 every couple hours. But before long, we were doing hundreds and hundreds of inbound leads per day. And it was way more than what I could handle in my business and with my practice. And, it was way too much. And all this while we'll continue to blog. So, I began to take leads that were, I'd written some optimization scripts. I'd gone back and done regression analysis. I looked at which customers were most likely to work with me. Where did I have the most success? Who of all the customers coming in based on certain traits, like where was I most productive? And I started kind of sectioning out those customers, and all the rest of them I was selling. And I'd sell to, some of the largest mortgage lenders that you know of.
You'd sell the leads. So you had inbound inquiries because you had the content there. And
yes.
So you got a bunch of leads. And,
yes.
And were the leads, were they like rate quote leads? Like, how much is my mortgage going to cost?
Yeah, some of them, but a lot more of them were, how do I buy a house? Right. Or it was users people who come to the website that were responding to questions that weren't, I'm comparing three mortgage rate quotes, right? And so to kind of contrast, on that first day at work, when my boss was like, hey, go make friends with realtors, what does that do? That means that when a realtor sells a house, they slide 3 business cards across the table. And, you want your card to be one of them. Why? Because that home buyer is going to call 1, 2, 3, see who's got the best rates, and you're in a knife fight. and it's who's got the best rates. And that, whenever it's great to have good rates. Look, everybody has good rates, but when you're competing on rate, that's not a viable long-term strategy, because there's always going to be somebody who's willing to work for less, always.
Yeah.
And so I was actually getting ahead of the realtor. Before anybody would contact real estate agents, this is right as Zillow was coming up, as Trulia, and people were scrolling websites from the comforts of their home. They hadn't quite gotten the apps yet, right? Where they're, it wasn't quite like the late night scrolling Zillow to see like what it was. But what we were finding was that people were coming to us through Google and landing on pages that were initial interest questions, like 0 moment of truth type stuff. How do I buy a house? What kind of credit score do I need to buy a house? How do I break my lease? What is it? What is a condo? Like really early stage stuff.
What is a condo? That's interesting. I see on our YouTube channel that some of the questions, the comments will be like, "Is now a good time for me to buy?" Yeah. Those are pretty fundamental questions and universal questions.
Yeah. And so they're early stage, right? And it was before the whoever was doing the search, it was before they talked to a real estate agent, and before that real estate agent had a chance to slide 3 business cards across the table, and before the customer even understood why their mortgage rate matters. Really, these are just fundamental, like, how do I get to this next stage of my life?
Yeah, I'm thinking about this.
Yes.
Yeah.
And so a really interesting thing started to reveal itself, and that was one of our biggest lead buyers at the time, major mortgage company, was like, "Look, we really love the traffic that's coming from your site. You're delivering great customers. They're super high intent, and they're giving and they close at 2.5 times our national average, and like we love them, but we need you to add a question to your form." And I had this intake form, like, "We need you to add a question." I said, "Sure, what is it?" And they say, "We need you to ask for purchases. How long
soon are you going to buy?"
Yes.
How long until you want to buy a house?
Yes. And so they're like, "We have 5 possible answers. 4 of them are dummies. Like, we don't care. Okay, I'm already under contract. I just need a pre-approval. I'm out looking with a real estate agent, 3 to 6 months. Like, we don't care what you put there. But the one answer that we're looking for is 6 months or more. And if that person says, 'I'm not buying within the next 6 months,' we don't want your lead. We don't want your customer."
Oh man, they were said that's a disqualifier, is 6 months.
Disqualifier. First time home buyer, or somebody with a very long time frame. And it makes a lot of sense if you think about from the mortgage perspective, which is, depending, like, we're filming this today, it's February 22nd. I don't mean to timestamp your podcast, but February 22nd. But this goes for every single month. Okay, today's February 22nd. There's only a few days left in this short month. And if you are a mortgage loan officer, you are dead focused on getting your loans funded by February 28th, because that means you get a paycheck for February's loans. Close everything in February so that you can get paid now.
Yep.
And so if you are a home buyer today and you call up a mortgage lender and you're like, "Hey, I want to buy a house," and they're like, "When are you buying?" You said, "Well, I'm probably going to somewhere between Thanksgiving or Christmas." And say, "Great, call me back in the fall." Click. Because mortgage lenders are not really, they're not incentivized to do that long process. It's about, what can I close now?
So, and they don't have a nurture process?
I mean,
apparently not.
Everybody says they have a nurture process, but nurturing is it's highly nuanced and needs to be very specific. And if you think, your real estate clients know, like, you can stay in front of people as often as you want, but if you're not there at the right time with the right message, they're gone. So this particular lender, this big lender, they said, when we're dealing with somebody who is buying a house more than 6 months, our closing rate on that customer approaches 0. Like, it is effectively 0.
Right.
And so they're like, "We don't even want it." And it was interesting. And so I kind of contrasted that to my regression analysis that I had done. And I realized that first-time home buyers or people with long time frames, I was excellent with. Why? Because I continued to make good content, because I continued to reach out at times that made sense. And like I had a system that was there. And there was the second thing that was happening too. Pardon me telling this whole story. This is
great.
To me, this is
I know where this is going. I know where the punchline is going to be homebuyer.com. I love the long setup.
But this is the realities of our market, right? And so the second thing that was happening, or that still happens, is that mortgage lenders they're paid on a percentage basis, right? So very similar to realtors, right? If you sell a $500,000 home, a $500,000 home yields a smaller commission than $1 million home. So what do real estate agents often try to do? They try to sell more expensive homes because they only have limited time in the day. And how you spend your time, you have to decide, where should I spend my time? And the personal economics says, optimize for your personal economics, which is sell the highest house and the customer that's closing today. And it's the same with mortgage. And so when you look at filters that mortgage lenders, the mortgage lenders rarely own their own acquisition channels, right? They go out and they buy leads from every probable source, and they spend a lot of money for it. And the ways that those leads are priced, higher value loans are worth more, or there's filters. I won't accept any customer that is below X dollars, is what mortgage lenders do. And so what ends up happening,
low, they won't.
It's not that they're not good customers. It's that I only have so much time in the day.
Yep.
To work on a $100,000 mortgage, I have to do 5 of them for a $500,000 loan, et cetera. And so what I found was that first-time home buyers with relatively small loan sizes were being completely ignored and continue to be ignored. It's not that they're not great customers. They are. They're conforming, good credit,
There's
good jobs.
Right.
They're wonderful customers. However, they fall outside of the scope of the typical mortgage lender's sweet spot, because it's not the mortgage companies that make the loans. It's the loan officers. The loan officers have to decide who they want to work with and who they don't. And so now you've put a human element on this whole thing. And so all of this from the last company coming forward, it's like there's this massive gap in the market. And it's wonderful because over the last few years, there's been so many wonderful technologies that have come out that have allowed loan officers and real estate agents and title and everybody to get more efficient. And suddenly it becomes a process-driven business. And so to go back, I'm a software engineer. I think in terms of process. And so if you can apply process into a haphazard system, if you can create repeatability, you can find profit in customers and in segments of the market where most of your competitors have to stay away because it's a money loser for them. So all that, we're here in first-time home buyers, and it's, the best part about working in this particular segment is you have legions of home buyers who are mostly ignored. They're overlooked. All they want to do is participate in the American dream and literally can't get anybody to call them back. If they're more than 6 months, nobody wants to talk to them. If their loan size is too small, they can't get the return call.
And that's a fascinating contrast to the person who's doing a $600,000 loan, because they can't get the loan officers to stop calling them. Right? You can't put your name anywhere, because otherwise you get your name gets sold all these places, and that's a fascinating. So therefore, homebuyer.com is the company you started to be the lender to first-time home buyers.
To specifically service this segment of the market, overlooked, underserved, great borrowers, just not getting a fair shake.
Yeah, and you're so brilliant with the mortgage content and with both
Thanks.
written and video, and so I want to actually talk about a lot about content today, but I also want to talk about what's happening in the mortgage market today, because it's we're in a spiking rate environment, so we got lots to cover.
Yes.
So let's while we've been talking about the content which you use, written content, and use a lot of video to answer the basic questions, a lot of the basic questions. I know you do a lot of things like, what about this loan program? And what about that loan program? Tell me about your content strategy. And a lot of our listeners here and a lot of the Altos Research customers and a lot of the people who watch and listen to this podcast are realtors and they're loan officers and they're people in the industry everybody's trying to figure out how to reach the customers. So tell me about content strategy.
I think if we look inward, we all prefer to research on our own before we talk to a professional. And if we can internalize that and realize that this is a human truth, that we have so many tools available to us, especially when we're making a big purchase, by calling a salesperson, there is some internal feeling that now you've committed to that salesperson, and we all want to avoid that commitment. I generalize, but this is basically true. If you're buying a car, if you're buying a shirt, let me do all the research, and when I know what I want to do, then I'll call somebody and begin comparing. And so there's an aversion, especially for it may be different if you've been selling homes for 10 years or 20 years and you've built up a book of business and referral network, slightly different. But for your younger listeners and viewers, how are you going to get that first phone call? Is it by being the face next to the listing on Zillow? If that's the case, then you're just the person who's showing the house. And that's fine. That's a transaction. And that's a good way to do transactions, but it's not a great way to build a career, probably. The better way to build a career is to build lasting relationships that you as a foundation. So
you look at the content that you create as a foundation for lasting relationships.
At the very least, we know we're not going to get every piece of business, but at least we're going to get an at bat. And my batting percentage is pretty high. Ted Williams, he's down here at 406. And so, but that's what it is just to have the right to compete for business. And so the way that we look at that is by providing value early when the customer's on their own and creating a recognizable brand that people can recognize, by establish trust, establish authority, and just deliver repeatedly over and over and over again.
And I love that. That's such a useful framing for what am I writing about? What am I talking about in these videos? Why am I doing this work? And if you think about it as this is the foundation for a lasting relationship. And that lasting relationship means that I get that bat at the very least. And some of it's I get the phone call and it's done. But that is if I have to think about what am I writing about today? Am I writing for a search engine or am I writing for a lasting relationship is a really powerful way to think about it.
In all of us in the industry, you got to remember who your competition is for that traffic. It's not each other necessarily. Your competition is publications. Where are you buying your leads, and do a search for the questions your customer asks. See who the first 4 or 5 results are. I'm pretty sure that they're media sites. And the thing is, the advantage that everybody in the industry has is that we've sold before. And there's a difference between copy that's factual and copy that moves the customer to the next step in their journey. So if somebody wants to ask a question about FHA loans as an example, or if they want to talk about low down payment mortgages, there is a whole list. There's tens of millions of search results. But very few of them are written by somebody who is in the mortgage industry, who has actually sat across the table from a customer, heard their concerns, heard their fears, who understands what's actually happened when they actually ask, what is a low down payment loan? What they're really asking is, how do I buy a house? I just don't have any money. And so that's really what's happening here. So take your sales skills and put your pen to paper, start typing, do a video. But it's the advantage that all of us have over the incumbents. And so if you sit there and you're like, I don't know what I'd write about, I don't know how to do this, I'll never rank, no one will ever find me. Like, that's not true. Like, you have experience selling. And so take that information and anticipate what it is your reader's really asking. That second degree thinking is a huge advantage that all of us have.
So great. So great. There's such gems in that. So let's then talk about their fears, shift gears and talk about their fears right now. Mortgage rates just spiked up from, under 3 to 4, over 4%. It's the first quarter of 2022. How does let's talk about rising rates impact the market as a whole, and then specifically about your first-time home buyers?
Rising mortgage rates affect different parts of the business differently. There's an obvious impact on refinances. And the very quick story there is there's fewer homeowners eligible to refinance. Mortgage lenders look around and go, oh my gosh, our volume dried up, and have to make decisions. We can try to pivot into doing purchases, which historically they're not very good at. And it's like, oh my gosh. Or they can try to ramp up, well, let's do cash out refinances. Let's start talking about other things and find other ways to, other sales pitch.
And a couple of big players in the mortgage industry recently got really crushed because they were doing a bunch of refinances as rates fell.
The largest lenders, they're, the ones that you would top of mind, top of mind. Geez, I can't believe I just did that, Mike. But the largest ones, they're 80% refinance, they're 85% refinance, another one's 87%. And so when that business goes away, you're left with difficult choices. And a lot of it involves getting rid of staff, raising your mandatory loan fees, and trying to come out of whatever horror has just hit your company. And it's cyclical, and it happens, and the industry expects it. Broadly macro level, the industry expects it.
Yeah. Do some players respond with increasing fees? So like all of a sudden it's actually the rates went up, but also the fees went up for buyers?
Anecdotally, yes.
Okay. That is potentially a scenario that could happen. We're not talking about any firms.
Yes, we're not talking about anybody in particular, but there are some lenders that have done that, and they've raised their mandatory fees.
That's
and
right.
So that's one thing. So when refinances dry up or slow, you see a lot of layoffs. And remember, over the last few years, mortgage lenders were competing for underwriters and processors and everything, and they were paying huge signing bonuses. And now people are out of work, unfortunately. That is not to me, that's not a cyclical aspect. That's just failure to have a good business model. I don't think that's a good business model when you have to do that. Again, my first boss, was it make hay when the sun is shining or whatever? Like, no, the better thing to do is to create a consistent path of business that lasts through all markets, and that's purchase.
Yeah.
And there are a lot of mortgage companies that tout themselves as being purchase first, and who really have those skills developed and who think long game. Because again, when you're investing in purchase business, you're thinking 6 months, 12 months, 18 months ahead. It's a different way to work.
Yeah. Okay. So now rates are rising. The rate's spiking over 4. Maybe they get to so I'm interested in hearing what you think, where they might go this year. Like, how high can rates go?
I'm not in the business of making predictions.
Okay.
It's difficult to know because it is a global. It's a global market, and just when Roddy Piper used to say, just when you've got all the answers, I went and changed the questions. It's impossible. But what's interesting about the purchase market in particular, to me now, is that when mortgage rates go up, it affects different buyers differently. If you are a first-time home buyer, it's not a huge detriment. What we saw when rates started to rise at the start of the year was an influx in activity and inquiries. Rates start to go up, people go, oh my gosh, I better get a move on, right? Because when people are buying homes for the first time, they're not, almost never they're almost never buying for investment reasons. They're buying because they had a baby, or they're buying because they took a new job, or in a new city, although that's probably less relevant now. They've got married, or moved in
life events
with their partner, right? Right, life events. And life events don't care about mortgage rates. Like when you got to get out of your rent, and when you've got to start, when you want a house, you want a house.
Yeah.
And that becomes an emotional driver. It's not financial. And mortgage rates just become one more thing that, this worked out great, my timing's great, or too bad mortgage rates are up. People will buy regardless.
Life events don't care about mortgage rates. I love that one.
The other side, though, is what houses are available. And so when mortgage rates go up, if you bought a starter home and you were thinking about, I'm ready to expand. Well, I'm ready to expand into a larger home. We want to add another bedroom. We want a larger yard. We want to get to a certain school district, or we or I or whomever the homeowner is, right? You already have a place to live. And now if you're going to trade from 2.75% 30 fixed, and now you're looking at this new house that carries a rate of 4+. And you're like, well, wait a second. And so there's less supply that's available in those lower price brackets. I'd love to, I don't know if you know data off the top of your head, if you have this information, but the lower quartile of home prices is super interesting to me, because it's driven by it has a different group of buyers, right? You have investors that are coming in and trying to buy up properties. And we can talk about that in a second from a policy perspective. And then you have first-time home buyers. They're generally in that space. And then you have your existing homeowners there and new supply builders. Like, what are you seeing in that space now? And is it geographic? I'd love to hear what the data looks like.
So the demand is, in the past several years, has been across all price points, across all geographies, right? Our record low inventory has been a phenomenon everywhere. In the lower quartile is definitely, just like the higher quartile is, like, it's definitely geographic specific. So in some cities, the lower quartile are 100-year-old houses that have like unpaid taxes, that they're selling for $50,000. And that's not really a first-time home buyer opportunity. Like, that's not where the first-time home buyers are going. And so some of those will have less demand, if you're in a Cleveland, or something like that, but there's a sweet spot, and the sweet spot for the U.S. is right about $300,000, $300,000 to $500,000, and so the first-time home buyer, well-financed, the professional people who have income, maybe dual income, are looking at that range as the highest, and make that the highest demand segment of the market.
So I find it, to me, it's interesting. I know that not everybody looks at it, and I know you care about it too. It's when you get between, say, Las Vegas and Pittsburgh, right, and where home sizes or home values tend to be lower. There's a big push for investors, and you hear stories about individual investors or large investors coming in and buying up many properties, right? And so one of the things that is favorable is, I think, our government has learned from the housing downturn at the end, 2008, 2009-ish era. And that housing has become, recognized as the keystone to the economy. And as housing goes, so goes everything else, or the ability to help people own homes, build roots, to fill communities, and to create generational wealth. And, we saw the opposite effects when there weren't enough protections, or say in 2009. But so one of the interesting things that the government's been doing over the last bunch of months, and I'd say at least since the current administration, is this big push to incentivize first-time home buyers, and while at the same time to disincentivize investors, at least who use mortgages. And so there's now they call loan level pricing adjustments, which is risk-based pricing.
Oh.
So let's say you're taking a loan, Fannie Mae, Freddie Mac, and the base price of a loan is, X percent. That if you are buying investment property, it's widely recognized that this is higher risk. And so as a result, you pay a higher rate. And if you work, or you make larger down payments, right? And if anybody, any of the viewers work with real estate investors who use mortgages, that, like investors pay higher rates and have to make bigger down payments. So the FHFA has extended those same risks now to second home buyers and vacation buyers. And what that does is it's just another way to disincentivize, non-primary homeowners, right? As a way to leave more housing supply for renters who want to buy their first home. And as mortgage rates go up, that different, it becomes more stark.
Does
right?
it even become more impactful?
Suddenly it's the math of owning that property. I'm just going to have a second home and I'm going to Airbnb it or rent it out as a short term, Verbo, whatever. That becomes less economically viable, and so that kind of opens up a little bit for more first-time home buyers to come in and again to build generational wealth and to close the home ownership gap between races, which is a big deal.
So policy-wise, you see the policy is trying to incentivize first-time home buyer over the investor type.
Yes.
And what's interesting is that right now, one of the big drivers of our inventory crisis is that when money's been super cheap, it's been really, really affordable to buy the second one and keep the first one. And now I have an investment property, and now I have two homes, and maybe do that a couple times. I talk about this a lot in the work that I do on Twitter and things, where we can see right now that it's about 20% of the purchases are investor purchases, and that's not like hedge funds necessarily. That's mostly individuals, and so seems like a really high percentage. And so how quickly do we think that some of these policies are going to take hold? Is that a 2022 shift?
That's live now. That change is live now. And to add some additional color to your point is that investor may not be going in and I've got some extra cash, money's cheap. They may not be buying a home in San Francisco. Where do you go to buy properties? Well, you look in areas between Las Vegas and Pittsburgh, and in a place like Youngstown, Ohio, where the average home is selling around $95,000, Wichita, Kansas. And so in these typically lower home valued communities, it's becoming prohibitively expensive for first-time buyers. Different from in coastal cities where an investor may be less likely to invest. And I say that not with lots of data to back that up, but just from our experience and what we see, in and around our communities where our customers are. One of the things that the Biden administration campaigned on, in fact, was this closing the home ownership gap. And so this has been a big. It was mentioned on the campaign trail. I have notes because there's been now 6 bills introduced in Congress that are meant to help first-time homebuyers get into home ownership, and they've all kind of stopped at various stages of their bill piece, but they've been there for a long time, and we get so many questions about it because aspiring first-time homeowners need this push, right? They many of them were beat up, from the start of the pandemic, even through today. Like financially, were beat up, and have some means and want to buy a home and are unable to do that. And so there's 6 programs: the Down Payment Toward Equity Act, which is a $25,000 grant. That first-time home up to $25,000 a grant if you are a first-time home buyer, and you're also a first-generation home buyer. And so, and there's some other ways to beef up. So $25,000 is a great, like, given to you just for buying a home. 25,000. And so there's also the First Time Homebuyer Act of 2021, which is a $15,000 tax credit. So in theory, if you owed $0 in taxes and you were eligible to claim this tax credit, the Treasury would send you a check for $15,000 at the end of the year. Like, it's a tax credit for buying a home. You have the Uplifting First Time Homebuyers Act, which is a tax exemption piece if you happen to use a 401k in order to buy a home, and that's proposed to be doubled from 10 to 20,000. Uplifting, or you've got the Housing as Infrastructure Act, which is another $25,000 grant. But the Build Back Better has a piece in it, and the Dash Act, which isn't even about homeownership at all, but the Dash Act, somebody threw in a $15,000 tax credit for first-time home buyers. And in all of these, so many members of Congress are trying to will these programs into existence as a way to squash that homeownership gap that is widened between whites and blacks, Latinos, and all the demographic groups that are tracked. We see that it's getting wider. And so all of these bills are meant to level the playing field and designed specifically for first-time home buyers. Pretty fantastic. Even now, there's now a proposal to wipe out student debt, which is another thing, again, to push first-time home buyers. And then the question becomes, like, is there supply for them to buy? So as I said, the policy kind of moving second home and investment buyers out of the space, and then allowing first-time home buyers to move in and fill that void.
And in particular, the policy for the second home buyers or investors is that if you have your mortgage, basically there are Fannie and Freddie are buying fewer mortgages, so that therefore drives the rate up of those second home purchases.
That also happened. It's since been rolled back, but that was an early attempt.
Okay.
And now what's happened? It's a literal fee that is just attached to the mortgage, and it's represented as a percentage of your loan size. Many people, instead of paying the fee, they opt instead to say, roll it into my mortgage rate, more or less. And so it can raise your rate by half a percentage point, by a full percentage point.
I got it.
And then suddenly the math looks very different about buying that $115,000 property in Philadelphia somewhere.
Does that impact if I am doing a move up and I want to keep my starter home as a rental property? My new one is my primary residence. Now I have loans that are basically two primary residences. Is that true?
I think that's a question that needs more attention than we can give here.
Okay.
Your mortgage on the existing property is a primary, right? You mortgage it as a primary residence, but now it's no longer a primary residence. And in your mortgage documents, it says that if you ever intend to vacate or use it as a rental, you'll contact your lender.
But nobody does.
It's there in your documents that you contact your lender and you let them know.
Okay. Got it. Got it. Okay. So that's really interesting. So let's talk, like, so much to chew on here, but let's talk about millennials for a second. We've got millennials, a lot of the first-time home buyers, the millennials, they're finally in their late 30s. They have been famously overburdened by student loans. What do we need to know about millennials and what's happening and what's going to happen this year, or maybe the next few years? Like, what can you see based on your questions and things like that?
I broaden it beyond millennials, and I would say, when you think about first-time home buyers, everybody has, every couple of years of a generation has its own thing that sticks out that they're dealing with. And even, we still, we hear from first-time home buyers who are in their 40s or in their 50s. And many times it's just been, they don't see a clear path forward. And it doesn't matter how old you are. If you want to own a home, when it's time to buy a home, right? It's time to buy a home. And so I think by focusing on just millennials, we limit the conversation to our idea of what this demographic is. The reality is that there are millions of homeowners potential homeowners who've been unable to get out of renting and get into the next thing for them, which is home ownership. And over the last 10 years or so after Dodd-Frank, mortgage lenders and the FHFA and everybody but the FHA, everybody's modernized and has gotten better about evaluating risk and has gotten better about understanding what makes for a low default customer. There are more opportunities now to buy a home than there ever have been, strictly from a yes, you're approved standpoint. And a lot of us have this idea in our head of like, I can't buy, like I've got too much debt. I'm not stable enough. I have this, like these voices. And the reality is that mortgage guidelines are pretty simple. It's a bunch of check boxes, check the box, and you're approved. And constantly, we're having to encourage people to just, hey, let's see what's going on here. Like before you tell yourself you can't, why don't you let me tell you that you can't? Right, as your lender, like let us tell you that this is impossible. And the reality, Mike, is that most people are just fine and have a path forward. They just have to do the next thing.
Yeah,
like they're stuck. Do the next thing.
Do the next step. And I'm sure that's probably good life advice in general, Dan. But yeah, but it's scary. Like, I remember when I bought a house in 2015, and I run a company and I'm self-employed, and it took me weeks and weeks, and like, do I have a loan? Am I going to get a loan? Like, I buy a house once every 15 years or something like that. And so I don't know anything about actually buying the house. And it's scary. Like maybe somebody's going to tell me I can't get a loan. And like, I'm reasonably well compensated, but it's, so I can imagine how it must be if you're trying to scrape together, 10 grand for a down payment or something like that.
I even go a step further and remember that this is a segment that most people raise their hand for help, and nobody helps them. And so there's also a lot of defensiveness about it. And that's something I think the industry needs to do a better job of outreach and helping aspiring homeowners recognize that like there's a path forward.
Well, you're doing hero's work here, Dan. So you're give. You're a real giver. That's great. Okay. So I'm interested in a couple of things about the future and to getting your take on it. So I'd like to talk to my guests here. We can measure right now. We know the market's hot right now. We know there's inventory is tight and demand is high. But at some point, the trends change. So tell me, and there is also things in the future like technological change. There's financial systems. There are the open doors and a lot of innovation on the money side. So tell me about your view of the mortgage future next few years. What are interesting trends that we should pay attention to?
Everybody's a genius in a rising market. Most business ideas work when the market's expanding. And so I think having lived through multiple cycles in housing, I just come with a little bit of cynicism on these things. And so there are some of the newer models that have emerged in for buying homes or for financing financing a home. There's been a lot of really interesting models, and time will tell which ones can sustain a downturn in the market or even just flat. Right? How many of these business models are predicated on rising home values? And so, but there's a lot of big bets being made on a lot of very large companies, and some of them will pay off huge. Some of them will not. I'm a fan of, it's. I don't know if that makes me, get off my lawn or, if I'm a traditionalist or how you say it, but the mortgage market and the ways that the mortgage market operates and the way that consumers behave. Sometimes the answer to me, it's not about having alternative. To me, I equate that with the term creative. Creative financing has a negative connotation to me. There's a massive market for mortgages worldwide. It's supported by the U.S. government. It's, the bonds are bought by everybody everywhere, and I like playing in that massive pool with lots of liquidity.
That's great.
That's where I stand.
So most of the innovation, in your view, is probably marginal benefit at best, maybe goes away in a bear market. Is there anything in the next few years that you're optimistic about, like technology change or market forces change or policy? What are you optimistic about?
I'm optimistic about everything. That's why I run that's why I started a company. I'm always optimistic. Everything's going to be fine. And so you have some utopian future in housing where everybody who deserves credit can get it easily, where everybody who wants to buy a home can find one. And I think that future is out there. I'm not exactly sure of the path that we're going to take to get there, or what decisions will need to be made, but it's there. And it's easy for us to look at market today and with the pressures that the market faces and take the recency bias and say, this is how it's always going to be. Like, it's not. And it may be even to further extremes, right? But it'll get to a point someday. If you want to buy a home and you can, you deserve credit, you can get credit. If you want to buy a home, there is a home that you can buy. And that's my view. I'm optimistic.
That's your optimistic view. Great. Let's we've covered a lot of stuff. Are there specifics on mortgage rates and payments and fees and down payments and things that are changing this year that are more than just like, oh, rates went up? Are there things that are going to show up in our data watching,
Yeah, it's so typical mortgage guidelines are not, they're not static. And so it's common in any given year for there to be between 60, 70, 80 published changes to mortgage guidelines. And that's all in Fannie Mae, Freddie Mac, the FHA, USDA, the VA. They're constantly making adjustments to make sure that they're serving who their core customer is, right? Fannie and Freddie have a core customer. The FHA has a core customer. The VA, USDA, everybody has their core customer, and they want to make sure that they're serving their mission to reach those customers. And so you see small changes and adjustments that are made based on things that are happening economically. For example, student loan deferred payments were calculated differently during the pandemic because this was it was so widespread that student loan payments were deferred. Like, it changed the dynamic of how loans should be underwritten. And so it's hard to say like specifically what will change. The ones that I look for in particular are incentives. So like the tax credits, the grants, things that make it a different financial decision or make it easier for people to get into home ownership if they want to. Also, the pricing changes that make it less desirable for people to come into the market for whatever reason. And those are the ways that I look at it. It's from a standpoint of personal economics. Other than that, the changes that they just, we saw that people are now using crypto as down payments, and we need to make policy around how we source crypto and this, and so that may show up in the guidelines. And then once it's in the guidelines, then we all have to adapt. Does it materially change how many buyers? Probably not. There's 6 million home buyers every year, 7 million. That's not a much of a difference as much as pricing changes.
Got it. That's cool. So the constantly changing market is actually one of the reasons people need the information, right?
Yeah. And one of the things that we see as an offshoot of that is different mortgage lenders have different risk thresholds. And so there's this concept in mortgage lending, it's called investor overlay. This may be something that you know about, but I don't know if it's a common thing, is that the FHA, Fannie Mae, Freddie Mac, VA, USDA, they publish these base guidelines. When they publish their guidelines, like the rule book, here's what we'll allow. We'll back this loan so long as you meet the following conditions. And that's kind of like the base. But mortgage lenders always have the ability to lay more guidelines on top of, to overlay on top of what the minimum standards are. And so one of the things that we're already starting to see this year, the FHA, and I hope this isn't too much inside baseball.
Awesome.
The FHA has, they allow for no credit score. You can get an FHA loan with no credit score, but 580 is the generally accepted minimum to use their smallest down payment program. So in order to make the smallest down payment possible and use an FHA insured mortgage, 580 credit score.
580 is pretty low.
580 is it's below average. Many people fall or 580 or higher. Yeah. So the FHA also does a thing they call a compare ratio, because they're an insurance agency. And what they want to make sure is that they're not paying out more claims to one mortgage lender than to another. And so they look at everybody's defaulted loans and they say, okay, how do these compare? Whose FHA loans are defaulting way higher than everyone else? Who's lower? And they take that top bunch and they're like, you lost your FHA license. It'd be like being a bad driver and you're always getting in accidents. Now you can't get insured, right? So what do mortgage lenders do? They go, okay, we know the FHA allows a 580 credit score. We're going to ratchet up. We're going to ratchet up and say, we will do 620 only, or 640, or 660, because we don't want any loans to default lest we lose our FHA license, right? So that's a really effective strategy for a very large bank when markets are rip-roaring. But what happens when your refinance volume dries up and now you've got to do more loans? Hey, everybody, I know we said we were at 660 before. We should probably lower our minimum standard to 640 and bring in some more. And it's okay to take on that risk. Because like we've got to do loans. Like it doesn't matter if we lose our FHA license, like we have to do revenue. And so you're starting to see already that some of these investor overlays are going away. The mortgage lenders are making it easier to get approved to get a mortgage because they have to do more volume. They have to widen their aperture in order to keep revenue coming in. So already we've seen minimum FICO scores. These investor overlays have started to peel back, which has been an interesting offshoot of the refinance volume drying up. It's easier to get approved for a purchase mortgage than it was 6 months ago.
Fascinating. So that
I should have led with that story, Mike. I'm sorry. I don't know. That was buried down. But you're an excellent interviewer for pulling that out.
That's right. I love that, and that's great. Well, we put it on the Twitter thread. Why it's suddenly easier to get a purchase loan,
right?
And then make them listen to the whole 50 minutes of that. That's terrific, Dan. In fact, so many good insights, and like I said, this is my masterclass on mortgages. It's been really helpful to me. Let's start wrapping it up here. Are there other things that you want people to know about homebuyer, or last little nuggets of wisdom?
Just no. I think that all of us we're all in the business of it sounds corny to say the American dream. I sometimes say I'm like, the American dream, but it's easy to lose touch with the idea that it really is the American dream for so many people. And just to remember who the people are that we're helping and why we're helping them, and the work that we do it's life changing, and it is generationally changing when you can break a cycle of renting for a family that wants to get into homeownership. Just as a reminder, why do we do what we do? It's the thing that for me every day, it's like this is why I do what I do. This is I find great joy in this.
That's really great. I love how on Twitter you celebrate people who are announcing I bought a house. I'm the first person in my family to buy a house, and you share that.
They're not even our customers. They're just randoms. I get so excited.
So great. So great. I love that. All right. Let's so speaking of Twitter, where do you want to direct people to find you and Homebuyer and all your content?
Sure. Subscribe to us on YouTube. If you're watching this on YouTube now, we're at Homebuyer, youtube.com/homebuyermortgage. That would be awesome. I think it's also a good medium for delivering some of the messaging that we do. You can also, come to the website anytime.
Buyer.com.
That's right. Homebuyer.com. Come anytime. There's a newsletter if you're interested. I write them personally. My take on what's happening or what we're seeing in the market. And so, but go do your job and do things well and make more homeowners. That's the important part.
All right. Dan, thank you so much for joining us. That's all the time we have for today. That was our masterclass on mortgages with Dan Green from homebuyer.com. Thanks everyone for
5-day beard
with Dan with the new beard, and I'm sporting a little bit of a little beard too. Mine's a little grayer than I got a few years on you, and a little thinner on top. So thanks everybody for joining us with the Top of Mind podcast. More very soon, more next week. I really appreciate all of the participation and your attention. So more
thanks,
soon.
Mike.
Bye, Dan.
Thanks for listening to Top of Mind. See you again next time, and be sure to click subscribe to get future episodes.